with an emphasis on the CFA franc. Okay. So to start, the CFA franc is the acronym for currency that has been created in December 26, 1945, during colonial times. Originally, the acronym CFA franc meant the franc of the French colonies in Africa. So the currency circulated in the sub-Saharan Africa part of the French colonial empire. More than 70 years after its birth, the CFA franc remains a colonial currency. When I say colonial currency, it's because it is a French-controlled currency system still operating in 14 African countries. And we will see why this is, we could call it a colonial currency. But let's start by saying that the CFA franc actually covers two different currencies that obey the same principle. You have on the left-hand side, the West African Monetary Union. We have 8 countries belonging to this monetary union using the CFA franc. But in this case, the CFA franc acronym refers to the franc of the financial community in West Africa. So you have Senegal, my country, you have Burkina Faso, Mali, Ivory Coast, Togo, Benin, Niger, and you have also Guinea-Bissau, a former Portuguese colony that joined the West African Monetary Union in 1997. On the right-hand side, you have the Central African Economic and Monetary Community, and you have 6 countries. You have Chad, you have Central African Republic, you have Cameroon, you have Congo, Brazzaville, you have Gabon, and you have also Equatorial Guinea, which was a former Spanish colony that joined the group in 1985. So we have 2 monetary blocks, each using the CFA franc. Each monetary block has its own central bank issuing a currency called the CFA. The thing is, there's another country which is not in this map, which is the Comoros. The Comoros also issues the Comoros franc. The Central Bank of Comoros issues the Comoros franc, but technically speaking, it's the CFA franc because it is functioning exactly like the CFA franc. The only difference is that the Comoros has a different parity against the euro compared to the CFA franc, but we could say that it's another CFA franc. But in this presentation, we'll focus on the 14 countries using this currency. So since its birth in 1945, the CFA franc rested on 3 main pillars and 2 counterparts. The first pillar is the fixed peg to the French currency. So the French currency was the French franc until 1999. And since then, the French franc replaced the euro as the nominal anchor to the CFA franc. Why the fixed peg? Because the fixed pegs allows, an environment of so-called monetary stability. That means that there is no exchange rate volatility. Investors in the French currency know that the value of the French currency in CFA franc will not change. So the fixed peg could be beneficial to them. The free transferability means the free movement of capitals and incomes between CFA franc countries, between each monetary bloc, and between each monetary bloc and France. So the free transferability allows for the free transfer of capital and income. That means that French investors could invest and disinvest freely. And when they want to repatriate their profits, their dividends, they could also do it freely. The third pillar is the so-called convertibility guarantee by the French Treasury. The convertibility guarantee seems like a complicated concept, but it's really simple. It's the promise by the French Treasury to grant loans to each of the central bank issuing the CFA franc. You have 2 central banks, the West African Central Bank and the Central African Central Bank. So whenever those central banks are, short of foreign exchange reserves, they are short of dollars or short of euros, the French treasuries could provide them loans. So it's not a loan by the French Central Bank, the Bank of France. It's a loan by the Ministry of Finance of France, the French Treasury. So that means it's a budgetary commitment by the French Treasury to say that whenever you need foreign exchange, I could lend you, but I could lend you euros, not dollars, but euros. But central banks could themselves exchange the euros with dollars if they want. And this promise to lend euros has two counterparts. The first counterpart is that each of the central bank has to open an account at the French Treasury. That means that they will have their foreign exchange, part of them, deposited at the French Treasury. At the time of independence, it was 100% of their foreign exchange reserves. For example, well, if they sold the cocoa or cotton, etc., they would receive US dollars or pound sterling. The pound sterling or the US dollar would be converted at the Paris foreign exchange market to obtain the French currency, and that French currency would be deposited at the French Treasury. But the exporters would receive the CFA franc and would not, receive the dollars. The dollars would be held by the central bank, but the central bank would deposit it at the French Treasury. So that's how it works. And all the foreign exchange reserves of each monetary bloc are centralized by the central bank, and part of it is deposited at the French Treasury. So it was 100% after the independence. This has been lowered to 50% since the mid-2000s. There is a second counterpart to this so-called convertibility guarantee. The French government is represented in the organs of both central banks with implicit veto power. That means that the French government is sovereign over the two CFA francs. That means that the French government monitors monetary policy. The French government monitors exchange rate policy. That means, for example, if African countries want to devalue the CFA franc, well, they need, the agreement of the French Treasury. So this is basically the presentation of the CFA franc and introduction. My talk will be articulated on 4 points. The first is the brief description of French monetary imperialism in Africa since 1848 to the period of independence, 1960. The second part will describe continuities and change from the independencies to now. The third part is an economic assessment of the CFA franc, who benefited from it, who lost from it, etc. And part 4 will be devoted to a discussion of the alternatives to the CFA franc. So let's start with part 1, French monetary imperialism from 1848 to the independences, 1960. So the story of monetary imperialism by France could be dated symbolically in 1848, a date which coincided with the abolition of slavery in France. When slavery was abolished in France, the French slave owners were given financial reparations for the losses of their slaves. At that time, slaves were considered as movable assets. In French, we would say bien meuble. So they were not considered as human beings, but as assets, and they had to be compensated. And one part of the reparations was used by slave owners to set up colonial banks in some French colonies, like, for example, Guadeloupe, Guyana, Martinique, but also in Senegal. In Senegal, in 1853, it was under Louis-Napoleon Bonaparte. The Bank of Senegal was created in Saint Louis, north of Senegal. And it was created as a colonial bank with the money of the reparations. But it only started its activity in 1855. At the outset, the bank was dominated by trading companies from Bordeaux, France, and it was mainly used to defend the interests of the trading companies against the competition from local entrepreneurs. It financed mainly import and export activities. The Bank of Senegal was ended in 1901 and replaced with the Bank of West Africa, which follow the same logic of protection of metropolitan interest. Here you could see a banknote issued by the BAO, the Bank of West Africa, in 1937. And you could see that at the time, the banknotes were an instrument of imperial propaganda. In this banknote, you could see clearly the message that the French Republic is working for the interests of, the subjugated African territories. So you could see this kind of propaganda through banknotes. But in 1939, there was the creation of the Franc zone. And before that, I have to say that we were in an international monetary system between 1817 and mid-1930s, which was based on the international gold standard. And in this framework, the core countries' currencies, for example, the Britain, the US, etc., they have their currencies pegged to gold and convertible into gold. This monetary system receded after World War I, but was briefly resuscitated soon after. Britain ended the pound convertibility in 1931. So in this context of breakdown of the international monetary system, there was strong inter-imperialist rivalries and growing protectionisms. So the dominant powers recentered their economic and financial relationships around their respective colonial empire or backyards. That means they traded mostly within their empire than across empires. And sterling area was created in this context. France abandoned the gold standard 5 years after England did the same in 1936. So the Franc zone was created in September 1939, just before Second World War II, as a trade and monetary bloc for France. So within the empire, there was a common foreign exchange legislation, and there was free trade within the empire and protectionist trade policies outside the empire. So the Franc zone gathered territories under French domination in Asia, the Pacific, the Americas, and Africa. But the Franc zone was gathered territories that were on average less wealthy than the members of the sterling area. In 1945, there was the creation of the CFA franc. The context was that of the end of the Second World War, and France was ruined by the war efforts. There were many shortages, there were high increase in price levels, a lack of foreign exchange. So the French currency had to be devalued vis-a-vis the US dollar and British pound. And until then, there was something called monetary unity that was prevalent within the empire. Monetary unity meant one empire, one currency. The French currency circulated under different exotic forms in the whole empire, except for some parts of it. One technical question arose in that context. Should the French currency be devalued evenly throughout the empire, or should the rate of devaluation be variable according to the context? The latter option was chosen secretly by the French provisional government, and this gave birth to the CFA franc, officially created on December 26, 1945, at the same time as the Pacific franc. The Pacific franc still exists like the CFA franc, but it is a currency of non-sovereign territories which are under the tutelage of France. But on December 26, 1945, the CFA franc was declared at the Nascent International Monetary Fund by the French provisional government. And what is interesting about the story of the CFA franc at its birth is that it had a shocking parity vis-a-vis the French currency. One CFA franc equal to 1.70 French franc. 3 years later, in 1948, one CFA franc equaled 2 French francs. The CFA franc was hence born overvalued. That means that its external value was higher than justified by the level of economic development of the countries using it. In the case of Britain, for example, the African colonies of Britain, they had exchange rate values that were more or less, coherent with their level of economic development. But France chooses chose to give its colonies a highly overvalued exchange rate. Why? Because this was a way for France to reconquer the trade share it lost in its African colonies during World War II. Because with the war, there have been a disruption in the trade patterns between France and its African colonies. And to reconquer those lost trade shares, having an overvalued currency could be interesting for France in the sense that an overvalued currency is an handicap for exports. That means that, well, African colonies could no longer export, for example, to other parts of the world. So they have to try to have some so-called preferences to be able to sell things to France. At the same time, an overvalued currency is a subsidy to imports. That means that the French economy at that time was very weak, and they wanted to have some captive markets. So with this overvalued currency, this was a way to give an artificial purchasing power, international purchasing power to the colonies. So in a sense, the CFA franc contributed to the reconstruction of a devastated metropolis that didn't have enough, economic strength to face international competition. Part two, the changes since independence. With the accession to independence, most African colonies decided to issue their own currency as a symbol of their newly acquired national sovereignty. This put an gradual end to the colonial monetary blocks that existed in the continent. For example, we had the sailing area, the Belgian monetary zone, the Escudo zone dominated by the Portuguese, and the Peseta zone dominated by Spain. All of these monetary blocks, colonial monetary blocks, were dismantled except for the Franc zone. Why? Because the French government anticipated that decolonization was something inevitable. Because, the French had this Indochina war. They also had this war against Algeria, and they didn't want to have other wars in sub-Saharan Africa. So they said, we have to concede independence, but without a real handover of our sovereign powers on sovereign domains. And so France conditioned the accession to independence of its former colonies in sub-Saharan Africa to the signature of so-called cooperation agreements in domains like foreign trade, foreign affairs, external trade, currency management, defense, strategic raw materials, etc. So basically, the deal was, I grant your territory its national independence, but I remain sovereign over all the domains above. And you could see here some examples of so-called cooperation agreements between France and its former colonies at the time of independence. For example, in the case of Gabon, the same day they proclaimed their independence, they signed cooperation agreements, and you could read, quote, "The Republic of Gabon commits to facilitating the storage of strategic materials and products to the benefit of the French armed forces. Should it become necessary for security reasons, it also pledges to limit or prohibit export to other countries." And this was signed by the Gabon authorities the day of their proclamation of independence. You could see also other examples in the neighboring countries in Central Africa. For example, in the case of Congo, Chad, and Central African Republic, they signed collectively cooperation agreements. And you could read, quote, "The states of Equatorial Africa confirm their membership to the monetary union of which they are members within the Franc zone. All the revenue and expenditure operations of the states of Equatorial Africa will be made via the transfer or purchase of foreign currency on the Paris foreign exchange market." This meant that, your foreign currency revenue will be exchanged through the Paris exchange market and will be held at the French Treasury, with the account created by the French Treasury for their central bank. So it's called an operations account. So all of this was signed by elites at the time of independence. And there was a letter by the French Prime Minister at that time that summarized very clearly the principle of conditional independence. He sent a letter to his Gabonese counterpart, Léon Mba, in July 1960, and you could read in this letter, quote, "We grant independence on the condition that the state, having gained its independence, endeavors to respect the cooperation agreements. The one does not go without the other," unquote. So it was clear, if you want your independence, you have to be independent, but without the attributes of independence. So the context was also that most leaders who signed these cooperation agreements were trained in France, and some of them even have seated at the French parliaments as MPs, and often they would be loyal to French interests. All of them except for Sékou Touré. Sékou Touré had a different profile because he was a Guinean trade unionist, and he managed to demand independence of Guinea, which he obtained through a referendum in 1958, 2 years before the other African territories under French domination. Because in 1958, the French under General de Gaulle organized a referendum in their colonies south of the Sahara. And the referendum said, do you want to stay with France within a community, or do you want to take independence? There was only one nation who said, no, we want independence. It was Guinea, because Sékou Touré had a different profile. He was a trade unionist, and he manages to create strong alliances to win this referendum. That's why Guinea was the first to obtain its independence in 1958. And somehow this disrupted the whole decolonization process planned by France, because 2 years later, most of the territories would gain their independence. So this is Sékou Touré. He was the president of Guinea. But Sékou Touré decided to leave the Franc zone in 1960 because he said that this was too rigid. So Sékou Touré decided to issue, in fact, his government decided to issue a national currency. And as a retaliation, the French counter-espionage decided to organize a destabilization program called Operation Persil. And there have many aspects in this Operation Persil. One of the aspects was to train and arm political figures from the opposition to overthrow Sékou Touré. But there was another more vicious aspect, which consisted in using the printing presses of the French secret services to create counterfeited Guinean banknotes and to put them en masse into the country. And the operation was a total success for one of his mastermind, and you could see it in this slide. His name is Maurice Robert, and he was the chief of the French secret services abroad. And he said that in a documentary movie that the operation was a total success, and this was a clear message to Guinea and to other countries that might have been tempted by monetary independence or simply political independence from France. There have been other instances of imperialist repression. This is also the case of Mali. Mali was led by a socialist leader, Modibo Keïta, who decided to exit the Franc zone in 1962 because he said it's much too rigid. It's a colonial system, and we want to have, more room for maneuver for economic development, etc. And the French said, no, we want to maintain this system. So Mali decided to issue its own national currency. But Mali faced some retaliation, not directly from France, but from neighboring countries. For example, my country, Senegal and Cote d'Ivoire, implemented trade barriers against Mali, and Mali is a landlocked country. So this created also many difficulties for Mali. Keïta was ousted from power in 1967, and that same year, Mali joined again the Franc zone. But it used a so-called national currency, but it was national only in name because it was, like the CFA franc, co-managed with the French Treasury and French Central Bank. And Mali would join the CFA franc zone in West Africa in 1948. But between 1967 and 1984, Mali used a currency co-managed with the French treasury that functioned exactly like the CFA franc, but the only difference was the parity against the French franc was different. There is also another instance of imperialist repression is Togo under Sylvanus Olympio. Sylvanus Olympio was trained under London School of Economics, and he wanted to diversify, the economic relationships of his country away from France, etc. So he decided to launch currency, national currency. But on January 13, 1963, he was killed by Togolese soldiers trained in France, in fact, in front of the American embassy in Togo. And so with his assassination, Togo's national currency never saw the light of the day. So these were, some attempts to discipline the empire and to send a message to say that you have to stay in the CFA franc zone, otherwise you'll face retaliation. In the 1970s, there were some developments, and those developments were triggered by the international monetary system at the time, which was, moving from the gold exchange standard, because after the Second World War, there was this international monetary system called the gold exchange standard. That means that the currencies, national currencies, were pegged to the US dollar, and the US dollar itself was pegged to gold. And the US dollar could be exchanged for gold, but other currencies could not be exchanged for gold, but were pegged to the US dollar. And this system ended in the beginning of the 1970s. And there were some dissatisfaction of African head of states with the CFA franc currency arrangements. And at that time, let's say in 1968, there was a devaluation of the French franc. And this was a surprise devaluation, and the African head of state did not appreciate that, because all of their foreign exchange were held 100% in French franc. So when the French franc is devalued, that means that the international purchasing power of your foreign exchange reserves are also devalued to the same extent. And they were not happy with that kind of move. So even if most of them were not that progressive, they started to say that we want some reform because we want some development, etc. So France accepted some concessions. The headquarters of the two central banks, the Central African one, was moved to Yaoundé in Cameroon. And the Central Bank of West Africa was moved to Dakar in the 1978. So their staff previously was 100% French. And after that, it became Africanized. The mandatory deposit rate of foreign exchange reserve to the French Treasury was lowered to 65%. And the number of French representatives in the organs of the two central banks were lowered, but their veto power was still maintained. In that period, two countries managed to leave the franc zone, the Mauritania and Madagascar. Their depart would be compensated later on by the arrivals of Equatorial Guinea in 1958 in Central African Monetary Union, and of Guinea-Bissau in 1997 in the West African Monetary Union. In the 1980s, we had the Europeanization of the CFA franc. And first important date in 1994, because in that date, in that year, January 1994, France and the International Monetary Fund decided to devalue the CFA franc vis-a-vis the French franc by 50%, despite the opposition from most African head of states. This was the first devaluation of the CFA franc vis-a-vis the French franc since 1948. And the situation was really simple from the France and IMF point of view. Either you accept the devaluation or you cut off from international aid, and you will have no fiscal maneuver to pay, for example, your civil servants, etc. So most African states would accept that, but obviously this created a lot of inflation, as these countries are highly dependent on imports for their consumption and for their production. In 1999, the euro replaced the French franc and became the new anchor to the two CFA francs. And since then, the CFA franc is under the double legal tutelage of France and of the political and monetary authorities of the Eurozone. In 1998, November 1998, France negotiated an agreement with its European neighbors saying that, well, we want to anchor the CFA franc to the euro. We want the euro to be the anchor of the CFA franc, and we want to maintain the same relationships. But some European neighbors like Germany, the Netherlands were not happy because they sensed that this could be a kind of unfair advantage for France in terms of trade, for example. But they also feared that the so-called convertibility guarantee could put France in a situation where France would not respect the Maastricht Treaty, because the Maastricht Treaty says that while European Eurozone countries should not have more than 3% public deficit, etc. So France told them, well, in fact, this guarantee is purely nominal and nothing will happen. So they made this kind of deal. And Eurozone other members say that, well, we accept that, but if the membership of the CFA franc is to be enlarged, we have to be consulted first. If there has to be a devaluation, we have to be consulted first. If the so-called convertibility guarantee has to change in one way or another, we have also to be consulted first. So since then, we could say that, well, the CFA franc is managed by France and the Eurozone countries. And that's why in the 2000s, the Eurozone architecture was somehow duplicated in the CFA franc zone. And this could be seen in the modification of the status of the central banks, the BCAO and the BEAC, which formally became independent vis-a-vis their member states, but not vis-a-vis the French government. And they have also put a more stringent macroeconomic framework for national fiscal policies, replicating the Maastricht Treaty. So we could say that with the arrival of the euro, the CFA franc using countries became an appendix of the Eurozone. So part 3 is an economic assessment of the CFA franc arrangement. There had been a very interesting report published in the 1970s by the French Economic and Social Council. And this report was about the benefits of the CFA franc and generally the Franc zone, because the Franc zone covered other countries like, for example, Algeria, Morocco, etc. But most of them in the beginning of 1960s, they exited the CFA franc, the Franc zone. And so there was this report. And the first benefit identified in this report is that France can pay its imports from Franc zone countries in its own currency. This is a very important aspect because this is a kind of a privilege. Maybe some of you know that the French minister Giscard d'Estaing coined this expression, exorbitant privilege. He used this expression to say that the US dollar is king and the US authorities could, issue dollar to buy whatever they want, etc. So on credit. And the same exorbitant privilege associated with the US dollar, France also had it within the limits of the Franc zone. That means that France didn't need to hold US dollars or any other foreign currency to buy goods and services in the Franc zone. And this is an important geopolitical privilege. And this allowed France to save on its foreign currency and keep up its own exchange rate. For example, between 1948 and 1986, the French currency had been devalued 10 times. But they had this advantage that if they were to buy oil, they were to buy gas, they were to buy cotton, uranium, etc. in CFA franc countries, they didn't need US dollar for that. They only need their currency. That means French franc. The other advantage was that the French companies operating in the Franc zone benefited from captive markets, and the report wrote that there have been large and stable outlets for trade. And this resulted in trade surpluses with regard to the Franc zones. But also the Franc zone provided foreign exchange to France because the zone was recording trade surpluses with the rest of the world. The zone has a trade deficit with France, but it has an overall trade surpluses with the rest of the world. And when you have trade surpluses, that means that you are accumulating foreign exchange. And the foreign exchange at that time had to be deposited at the French treasury. And that report said that, well, when the French government had a budget deficit, sometimes they used this foreign exchange to repay the debt. Another advantage was that the French companies have the guaranteed freedom to repatriate their revenue and capitals without any foreign exchange risk, and also without any transfer risk. When we say foreign exchange risk, that means that they had the guarantee that the CFA value in terms of French franc would not change. The CFA franc value in terms of euro would not change. They also have the guarantee that there would be no transfer risk. That means that every time they are sure that the central bank will have enough foreign exchange to allow for the conversion of profits realized in CFA franc to be converted into French franc or into euros to be repatriated abroad. And so you have also this advantage. Another advantage is that the French government enjoys a system of political control serving its own economic interests that doesn't cost it anything, since its supposed convertibility guarantee has rarely been put into effect. Well, the central banks of the CFA franc zone are obliged to deposit their foreign exchange. On the 2000, it was 50%, but at that time, I mean, before the 1970s, it was 100%. And normally, the French guarantee could only be activated if the level of foreign exchange reserves is zero or tends to be negative. In that kind of context, the French government will step in to provide loans. But the thing is, rules have been made so that the central banks will never be in a situation where they would lack the foreign exchange, because there have been some rules saying that whenever the total foreign exchange of the central banks are lower than 20% of the central bank liabilities, so they have to change monetary policy to have a harsher monetary policy so as to reconstitute their foreign exchange reserves. So that means that, well, there has been no guarantee, in fact. And the thing is, generally, the interest rate paid by the French government on these deposits at the French Treasury, generally, the nominal interest rates have been lower than the inflation rate. When the nominal interest rate is lower than inflation rate, that means that the real returns are negative. And when real returns are negative, that means that, in fact, central banks have been paying the French Treasury in real terms, so that the French Treasury holds their foreign exchange for them. That has been the situation of the foreign exchange held at the French Treasury for the last 6 decades, basically. And well, that means that this is a political system which France could use and which has management costs that are basically nil. And the other thing is also that there had been a court ruling by the French Conseil d'Etat, which is the highest French administrative court, which confirmed that this is a kind of a colonial currency. And this ruling dates from 2012. And in that ruling, it was said, quote, "The management and control of the BEAC, the Central Bank of Central Africa, is notably ensured by France's representation within this body. The activity of the BEAC, which governs monetary cooperation between France and 5 Central African countries, actually it's 6, 5 Central African countries, is of particular interest to the French economy." So you have a court ruling saying that, well, this is something of interest to the French economy. So what's wrong with the CFA franc currency system? We have 2 aspects. The first aspect is political. This is a currency system still under domination of the French government, who controls and decides over monetary and exchange rate policy, The coins and notes are still manufactured by the Bank of France in France, and the French can impose monetary sanctions against dissident governments. And this happened twice. In 2011, France weaponized the CFA franc to cut off the Ivorian government at that time, led by Laurent Gbagbo, and they ordered the central bank to cut off the access of the Ivorian government to its account at the central bank. And central bank also stopped the refinancing of the domestic banking system, and the external operations were also stopped. The French banks also stopped any operations domestically in order to asphyxiate the domestic economy and put pressure on the Laurent Gbagbo government. And this also happened recently in Mali. Last year, because there have been, some, let's say, quarrels between the Malian government and the French government. So economically speaking, there are a number of issues. And the first issue is the peg, because the fixed peg is harmful to the two CFA franc currency unions. It prevents the use of the exchange rate as a shock absorber and condemns African economies to severe austerity policies during bad economic cycles. So that means that it's pro-cyclical, not anti-cyclical. See, and the thing is also, as the peg to the euro makes the CFA franc overvalued, this is harmful to the export of the CFA franc countries and condemns African economies to rely heavily on imports, sometimes from the Eurozone. And therefore, this contributes to maintain African countries using the CFA franc as producers of primary products. And the peg also is sustained by the limited credit creation by the banking system. There is limited financing available for the productive economy. And there are also high levels of profit remittance and illicit financial flows associated with the free transferability policy. So sometimes you see there are benefits of monetary integration. And generally, one of the benefits supposed of monetary integration is more trade between the members of the monetary union. But in the case of the zone franc, sharing the same currency did not lead to more trade between African countries, because they are still producers of primary products. So you see that intra-regional trade is just 10% of the external trade of the African zone franc. In the CIMAC countries in Central Africa, the regional trade is just 5% of their external trade. Sometimes people could speculate that if you have a fixed exchange rate and lower inflation rates, this could be, conducive to more financial attractiveness. Countries will be able to attract foreign investment, etc. But this is not the case. For example, in West Africa, Ghana, which has its own national currency, had a stock of foreign direct investment higher than all the 8 countries using the CFA franc combined until 2019. When we say stock of foreign direct investment, is a net accumulated flows of foreign direct investment for the last 4 or 5 decades. So Ghana had a stock of foreign direct investment higher than all the 8 countries using the CFA franc in West Africa combined until 2019. In Central Africa, the Democratic Republic of Congo, which has its currency, a dollarized currency, had also a higher stock of foreign direct investment than 5 out of the 6 countries belonging to the CIMAC, the countries using the CFA franc in Central Africa. So having a fixed exchange rate and having low inflation is not conducive necessarily to financial attractiveness. One argument for the CFA franc is that, well, they have low inflation and exchange rate stability. Yes, that is true. Yes, if you take the case of my country, Senegal, you could see, for example, between 1996 and 2019, before the pandemic, in terms of average rate of inflation, there was only one country in the world that had a lower average rate of inflation. It was Japan. Except for Japan, the second top country in brackets in terms of average rate of inflation was Senegal. But this is completely madness for a developing country. And we'll see Why? Because this deflationary environment was not conducive to long-term economic development. And in this table, you have the countries of the Franc zone: West Africa, the WAMU, the Central African countries, and the Comoros. And in the economic development literature, there is this finding that in developing countries, they could have growth spurts. That means they could have, 1 decade or dozens of years when they record good economic growth. But sometimes these spurts are interrupted, by crises, etc. And so the past accumulation is somehow hijacked by this economic crisis. So that means that what is important in developing countries is to look at the economic growth from a long-term perspective, using many decades. And when you do that exercise, you see, for example, that Cote d'Ivoire, which is the richest country in the whole zone Franc, their best level of real GDP per capita. When we say real GDP per capita, that means that, well, it's inflation adjusted, it's exchange rate adjusted. So it is supposed to measure productivity over time. And you see that the best level of real GDP per capita by the richest country in the Franc zone was 1978. That means 45 years ago. In 2021, the real GDP per capita of Cote d'Ivoire was 23.6% lower than its best level it recorded in 1978. And this has been the pattern for most of the countries using the CFA franc. You take the case of the Niger, it's one of the poorest countries in the world. Its best level of real GDP per capita was in 1965. In 2021, its real GDP per capita was 43.2% lower than this best level of real GDP per capita achieved in 1965. And you could see the same story in Gabon, in the Republic of Congo, in the Cameroon, etc. Even in the Comoros, you could see also that kind of pattern. That means that the countries using the CFA franc, the dominant pattern over the long term has been either economic decline or stagnation. And you could see that also in terms of human developments, for human development indicators. You could see, for them, in 2018, Niger, Central African Republic, and Chad, all members of the Franc zone, they had a lower score on the Human Development Index, an index that is computed by the United Nations Development Program. And they were the three at the bottom of a rank combining 189 countries. And overall, 10 out of the 14 CFA franc using countries belong to the low human development group. The other thing is also that this zone suffers from illicit financial flows, capital flight. And there have been some economists that have done interesting work on capital flight in Africa. This is the case of Léonce Ndikumana and James Boyce. In their book called Odious Debt, they gave some estimates for the Franc zone. And you could see, for example, in Cote d'Ivoire, between 1970 and 2008, capital flight representing 66.2 billion US dollar. This was 6 times the foreign debt stock of Cote d'Ivoire in 2008. The same thing with Cameroon, 33.2 billion US dollar of capital flight over this period. And this represented 13 times its foreign debt stock in 2008. The same thing for Congo, the same thing for Gabon. That means that the CFA franc contributes to the financial bleeding of these countries. So the last part quickly, what are the alternatives to the CFA franc? Because there have been growing protests against the CFA franc. I have to say that generally speaking, there have not been popular mobilization against the CFA franc. There have been some intellectuals denouncing this currency, but this remained an intellectual discourse. It's only from 2015 that a popular movement, Pan-Africanist movement within Francophone Africa and its diaspora, that this movement emerged to contest the CFA franc. For example, in my home country, Senegal, you could see people writing on the walls France dégage, meaning that, well, France has to leave. This slogan was used first to say that France has to leave the CFA free system, but now people are using it to say that we no longer want military bases, French military bases in Africa, etc. So what are the options to move out of the status quo? There are 5 main options. The first option is what I call symbolic reformism. It consists of touching only the visible symbols of monetary coloniality without altering the fundamentals of the CFA system. This includes proposals such as changing the name of the CFA franc, having banknotes and coins manufactured outside of France, and even first reducing the deposit rate of foreign exchange reserves at the French Treasury. This is the option championed by the French government, and especially French President Emmanuel Macron. Emmanuel Macron went to Cote d'Ivoire in 2019, December 2019, and said, we want a reform for the CFA franc. They made some announcement, we are going to change the name of the CFA franc, etc. But the reform announced was just cosmetic because it did not change, the system. They pledged to change the name, but in fact, this is they tried to hijack another regional project by stealing the name of the currency plan for the region, for West Africa. So this is symbolic reformism, and that is the option contemplated for now by Emmanuel Macron, the French president. Option 2 is what I call adaptive reformism. It consists in adapting the CFA zone to the current context marked by the economic and geopolitical decline of France and the euro, but with the ultimate objective of maintaining. So some proposals include making the parity of the CFA franc more flexible, because people know that the peg to the euro is too rigid and undermines the price competitiveness of African countries. And because the African countries trade relatively less and less with the Eurozone. Other proposals include Europeanizing further the CFA franc management. Instead of a French guarantee, we would have a so-called European guarantee. And instead of French representatives, we would have European representatives. This is the option that have been put forward by the former French Ministry of Finance and former IMF Managing Director, Dominique Strauss-Kahn. But I would say this is wishful thinking. Option 3 is what I call neoliberal abolitionism. Option 3 requires the demise of the franc zone, the abolition of the franc zone. So it promotes an exit from the CFA franc that follows the neoliberal monetary integration model, the Eurozone type. And in March 10, we will discuss about this monetary integration following the Eurozone type. And I call this neoliberal abolitionism. Unfortunately, this is the option put forward by those who promote the idea of a single currency for the 15 countries of the Economic Community of West African States, which include the 8 countries using the CFA franc and 7 other countries that have their own national currencies. So since 1983, the ECOWAS bloc had a regional currency project, but the launching of this currency had been postponed several times during the last 2 decades due to a lack of technical preparation and to a lack of political will. CFA franc using countries prefer to remain under the monetary tutelage of France, while Anglophone countries refuse to be part of monetary union where France have any role whatsoever. But we'll discuss about this on March 10. So option 4, it's the Bitcoin option. And some times ago, last year, September 2022, the Central African Republic decided to adopt Bitcoin as a legal tender. And obviously, this was not welcomed by the Central Bank of Central Africa. This was not welcomed by France, neither by the IMF. And this is also a very desperate option to my point of view, because you see Bitcoin is not a currency at all. It's a speculative financial asset. And in Central African Republic, you have 10% of the population who has access to internet. And when you see the value of the Bitcoin, you see also that it could not function as a medium of daily exchange, because you see that one Bitcoin is equal to 13 million CFA franc. That means 22,000 US dollar when we use the exchange rate values of today, 6 March 2023. The last option is what I call sovereign abolitionism. It refers to an exit from the CFA franc that breaks with the neoliberal model of economic integration and that strengthens the sovereignty of countries individually and collectively. And in this kind of system, we could talk about a solidary national currency system. That means that each country of the CFA franc should have its own national currency issued by its national central bank. An African monetary fund could be created where part of the foreign exchange reserves of African countries are pooled in a way to create solidarity in the management of their foreign exchange reserves. There could be a common Pan-African payment and clearing systems in a way that allows these countries to trade between themselves without using the euro or the US dollar. And last but not least, these countries could adopt common policies to achieve energy and food self-sufficiency, because generally they have deficits in their balance of payments in these two areas, energy and food. And if they manage to have food and self-sufficiency, that means that they could save on their foreign exchange reserves and they could allocate that to their industrial development, etc. And this option, sovereign abolitionism, has been advocated by one of the best African economists we had, Samir Amin on the left, Franco-Egyptian economist, and on the right you have Joseph Tujankwemi, Cameroonian economist, who wrote this book, Money, Servitude et Liberté, Money, Serfdom, and Freedom. Unfortunately, he passed on very early in 1984, but he wrote this very powerful book where he advocated a system of solidary national currencies for African countries. So I will